Well, hello everyone. It's April the 14th. It's a Tuesday. It's a day right after Easter holiday, one of the biggest holidays of the year. And as I always say, let's get into it right now. So starting with the news, and right now news is really important because there's a lot of factors involved. We've got earnings coming this week. It's going to be big. We got Fed data tomorrow and Thursday. And we've got a lot more coronavirus information. So let's get into it right now. Data released Tuesday shows Chinese exports fell at a slower pace in March than in the previous 2 months, which is interesting. Forecasters warned of harder times ahead as the coronavirus pandemic depresses global demand and disrupts production. We know that. Beijing is due to announce economic growth for the first quarter on Friday, and a raft of potential dismal corporate earnings are in the pipeline. We know that too. Cautious optimism that the outbreak in the U.S. has begun to plateau in some of the worst hit areas like New York. Another big infusion of economic support by the Federal Reserve helped spur a big rally last week. Oh yeah. Analysts predict that earnings, and this is important because it's this week earnings start, for all the companies in the S&P 500 will be down 9%. That's the target. That's what is the market is going to assimilate into its value. So you got to keep that number in mind. 9% for the first quarter from a year earlier. That would be the biggest annual decline in earnings since the first quarter of 2009, when earnings slumped nearly 16%. So if you look at the perspective, consider volatility was higher, and the sell-off pressure was just as strong as it was in 1987 and 2008, but earnings are only down 9 versus 16, so that's already looking better. Johnson & Johnson reported Tuesday a rise in first quarter net income, not surprising, driven by purchase of over-the-counter medicine. Its shares were up almost 3%, but it cut its outlook for the year. Earnings and revenue at banking group JP Morgan fell. Other major companies that will be reporting this week include Wells Fargo, Bank of America, United Health, and Rite Aid. And also, I believe Citigroup is also in the top 3. There's more than 1.92 million confirmed coronavirus cases, led by United States with more than 582, according to Johns Hopkins. Now, again, it's going to be a very interesting few weeks because we're going to see if the earnings meet the expectations, if they're much worse than expected, and most importantly, if we're going to get any type of preview of what's to come from companies, or if they're just simply going to refuse to give guidance. Now, today is Tuesday, and Tuesday we cover the top sector for the week. And right now I'm looking at the healthcare, ticker symbol XLV. Why am I looking at healthcare? Well, it's one of the few sectors in the S&P 500 that's actually above its 50-day moving average and above its 200-day moving average. And this is the first day we see price action above the 5200 cross. We call that the death cross or the death star. It's got a bunch of interesting names. I don't really find it very effective, but it's been around forever. When the 50-day crosses the 200-day, either to the upside or to the downside. Now, I find it very, very interesting because if we can stay above the 200-day moving average for 2 sessions, which means one more session, the market will become bullish. But this is not the overall market. This is just the healthcare sector. But if we look at the NASDAQ 100, which we are going to look at right now, you will also see that it's trading not just above the 200-day moving average, but above the 50-day line. So this is really, 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 really positive. Also, materials, basic materials are also trading above the 50-day line. So we are seeing some upside. Now, as far as stocks in the healthcare sector, and remember, we're going to have earnings, but healthcare doesn't usually report till they're more towards the later part of the session, part of the reporting cycle. We've got banks, then we've got technology, then we've got consumer stocks, and then we got healthcare. Now, obviously, there are some that are sprinkled in between, but for the most part, healthcare comes later. Now, let me tell you some of the stocks that I'm looking at in this sector that are near all-time highs right now. These stocks are killing it. This is the NASDAQ 100. No, this is the S&P 500, excuse me. And I wanted to give you the best healthcare stocks in the top. So Regeneron, Vertex, Insight, Gilead Science. These are top. There's also BIIB Pharmaceuticals, but I would stick to Regeneron, Vertex, Insight, and Gilead Science. Those are the top sectors. Ticker symbols are REGN, VRTX, INCY, and GILD. And you can rewind the video. You can get all of them here. The bottom line is right now, I like what we're seeing. I like the fact that that volatility is a little lower right now. It's not as high as it was before. Let's take a look at the SPY actually and see if we can get some better ideas. See, the SPY is lacking behind. Notice the SPY is not even at the 200-day or the 50-day. But if you look at the healthcare sector, or if you look at the Nasdaq 100, we're already above. And if you look at the healthcare sector, you will see, look at that. Look at that. And now let me show you the S&P. Big difference, right? Like that one's like all the way up here, and the SPY is all the way up here. So you could see healthcare has a lot more upside potential than the broad market, and I'll tell you why. Let me explain to you why. The reason is because you've got the energy sector, industrial sector, and the financial sector, and some of the real estate sector as well, really putting a lot of pressure on the overall S&P 500. Whereas the healthcare sector, look at that, it's number 2, right behind technology, and there's very little holding it back. And as you could see, it's already above the 50-day line. Now, you may want to ask yourself, why didn't I recommend technology? Well, technology's been rallying really hard the last few days, and it's just, I believe we have more upside in healthcare than technology because we've got all these discoveries coming out that will help fight coronavirus, whereas technology is more like utilities right now. Everybody's using the internet to communicate. It's like internet has become like water, right? Like transports and like utilities, but healthcare is still the key to solving coronavirus. And I think we're going to see a lot of upside. And as you could see here, it's not, the healthcare sector is not trading above the 50-day moving average, but the tech sector. But the healthcare, I'm confusing the tech and the healthcare, but the healthcare is, look at that. Healthcare above the 200-day moving average, above the 50-day line. But technology, above the 200-day line, but not above the 50-day line. So I'm putting more value and more market cap into healthcare over the near term to help us get out of this mess, especially in the near term. So you definitely want to keep your eye on stocks like Insight, on stocks, let me just do this for you quickly here. Yeah, you definitely want to focus on stocks like Insight. You want to focus on stocks like Regeneron. You want to focus on healthcare, top healthcare stocks. That list that I gave you, the list of 5 stocks a few minutes ago, probably the best list right now. I expect those stocks to remain in the top 10 regardless of where the market's going to go, because I think funds are going to be very keen on investing in biotech that has very strong potential to mitigate or cure coronavirus. I think that's going to be the next big thing. And I think any stock that finds something similar to what I described is going to get into the S&P 500 and is going to develop a lot of institutional sponsorship quickly. So again, healthcare sector is where you want to be right now. Now, with everything going wrong with the market right now, have you figured out a plan B yet? You've got to have a plan B. Job security, it's gone. Interest rates, they're on the floor. And shrinking dividends, well, that's the new norm. So what's the answer to staying afloat in what feels like total market chaos? On-demand income is your answer. I mean, on-demand income will get you through this. And I'm going to reveal exactly, step by step, how to do it today at 1 p.m. Eastern Time. Main Street investors are tapping into Wall Street's super strategy to pull thousands out of the market, regardless of market direction. And that's the key. Income on demand, regardless of market direction. You know what that equals? Recession-proof strategy. I love the way that sounds. Recession-proof strategy. So you don't want to miss this. Make sure to click the link or the button after this video. Enter your email to register. Folks, you don't want to miss this. On-demand income. Economy's going to crap. I'm going to teach you how to make income on demand, irrespective of what the market does. Market goes up, doesn't matter. Market goes down, doesn't matter. Market goes sideways, even better. You know how often the market goes sideways? 70 to 75% of the time. Do you know what the market does most often after a big move like we've just seen? Move sideways for about 4 months. We saw it in 88. We saw it in 2007, 2008. We saw it after every big recession. After a strong directional move, what does the market do? Move sideways. What is sideways market best for? Income on demand, recession-proof strategy. Tap into Wall Street super strategy to pull thousands from the market. Follow the link below. Folks, you don't want to miss this. This is your plan B. I've got you covered. Talk soon. Follow the link below. You don't want to miss it. 1 p.m. Eastern time today. Take care. Have a great day.